signature that allows you to know that this amount of asset is in this amount of wallet, as is evidenced by this blockchain, right? It's really kind of all the stuff that you say around the crypto that makes it into something, right? So I'll give you an example. All right. What's this? Okay. So if I go and I say, here's a vape, you smoke it, it tastes good, it's kiwi, you'll like it, right? Say, buy it for $5. What's that in exchange of?
Value.
Value. What would this be? Like a product, a good, right? What if I said, all right, here's a vape. For every month that you hold it, you're going to get 5% APY. What does it become?
Investment.
Yeah. So by just saying stuff, I just turned this into a security, right? And that's kind of like the basics of what you have to remember is that your token really means nothing. It really boils down to what you say around your token that means something, right? Another example is, let's say I gave you $3,000, right? I didn't say anything. I gave you $3,000. And then I walk away. I come back 2 weeks of like, hey, where's my $3,000? And you're like, I thought I gave that to you. You're like, I thought you gifted that to me. I'm like, no, that was a loan, right? And then I say, but it's a normal loan, so I got to charge you 6% interest. There was nothing was ever written around that transaction. But with crypto, we actually do so many transactions without actually having any explicit kind of conditions or terms around them, right? So that means that there needs to be some sort of contract, right? Now, contracts can exist totally out of right. You can go and you say, hey, I'll buy your bike for $300. Someone gives you $300, you take their bike. There's no contract written, but there's a contract, right? And that could exist once those facts kind of come into play. So things to kind of keep in mind, just from a basic level, is a contract can always happen without any actual written contract. And when you're sending crypto, you're actually entering into contracts all the time, right? You're not entering into a smart contract or a written legal contract, but it is a contract, right? And a lot of times when things aren't written, there's a lot of potential for like some confusion. What did I think it is? What did you think it is? Blah, blah, blah. Who's bought an NFT here before? Okay, so what the hell did you buy? Was there a expectation of vibes when you bought it? Did the seller give you that expectation?
The seller gives you that expectation.
Yeah. But what happens if he didn't give you vibes? Would you ask for your money back?
You can. Can you?
Well, yeah, potentially. Yeah. So how many of you have bought an NFT that was representing an image, right? What could you do with that image? Do you know what you could do with it?
Depends on the IP rights
Well, exactly. So where are those found?
and the blueprint of the project.
Correct. So a lot of times these NFTs are sold, you don't know what the hell you're buying, right? And a lot of times it's a bit sneaky because they'll actually not sell you any IP rights. They'll sell you some license, right? And a license that they could do whatever they want with it. But then you're like, well, why the hell did I purchase something, on the blockchain that is representative of what, if you're retaining all the IP rights, right? So sometimes it's weird, but in the fine print, it really does matter, especially if you're buying something that you think is valuable. You want to be able to buy a car, and then there's a reasonable assumption that you're going to be able to drive it, right? If you buy a car and it breaks down, the guy's like, you didn't ask if it rode. You're like, damn, dude, that's fucking mean. So okay, any other questions just on the level setting there? Just wanted to level set that securities basically exist based upon the representations you make, right? Contracts exist, out of right. And sometimes you'll want to be careful about the reps you make and the contracts you sign so you can kind of have at least a reduction of risk around, misaligned expectations. Does anyone have any questions on that? point? No?
No.
We're good? All right. So let's talk about risk. So risk is like your sexuality, it's on a spectrum. And unlike that really confusing time in Mykonos where you got carried away with Alejandro, risk can be actually quantifiable here, right? And it can be quantifiable in legal. A lot of folks ask, a lot of folks come to me and they say, Tufik, I don't want to go to jail, right? Like that, a lot of people just come up and say that. But I'm like, you're not going to jail. But there needs to be an understanding of why legal is important. And legal can be important if you look at it from the perspective of risk mitigation, right? So how many of you guys have a mathematical background here? Okay, so do you guys know how to assess probabilistic outcomes based upon certain information? Is that correct? Right, so let's use an example here for you guys. So let's use the case of a company called BlockFi. Okay, so a company called BlockFi made, before it crashed and burned, this is an old example, but it's good, so I'm keeping it. They made $600 million in ARR a year. But then they paid a penalty, the SEC charged them a penalty of $100 million for, a variety of things that they breached. Was that a good use of risk? Was that a good economic breach of risk, or was that a bad use of risk? Like, would you say that was that a good business decision or a bad business decision?
I take 500 million. Sounds great.
Exactly. And that's how you have to think about legal. And this is not me just pontificating. There is a doctrine in legal called the doctrine of economic breach, right? What that effectively means is that legal can be quantified, from a dollar amount, and then that quantification can then be applied in your decision making, right? So I'll give you an example. Let's say the worst case scenario for you is gonna cost you $10 million, right? That worst case scenario has a probability of 1% of occurring, right? And the legal bill to reduce that risk to zero, this is a simple example, but I'm just using it. But the legal cost to reducing that risk to zero is $50K. Do you invest in the legal or do you not?
Definitely no. Because I have a question for you. How many people do you know in crypto went to jail? Very few.
I'm talking about but that's the thing. You're looking at a term called jail, and that is a certain outcome that I'm not describing in the model. The model that I'm describing is that you have a 1% chance of getting a $10 million penalty. So that's the outcome. Because if you look at the jail concept happens very rarely, but the penalty concept happens more often. Now, it still happens at a low probability, but the penalties can be extremely egregious, right? So if you have an egregious penalty, what is the cost for you today to reduce the risk of that penalty?
Expected value.
Exactly. It's the expected value, right? So if you have a $10 million risk that has a 1% chance of occurring, that is $100,000, right? So then if you would invest $50,000 to reduce that risk to zero, you have saved $50,000, right? Yeah.
The time factor is what's missing in that choice. So like there's a lot of teams here who will say the 10% chance of a company exists in 2 years, the 1% eventuality is after 2 years. I'm not willing to spend it because it's not worth runway against the risk against the time of my business. But if you look at that example as like it's a 1% chance of happening any second, like it could happen immediately, then you get rid of that time map that people trick themselves into. And if you say at any point you could be, obtained, detained for fraudulent activity, whatever, then it's a very different choice. You want to spend
Well, absolutely, and you're absolutely right. No, you're absolutely right. But that's where
He's my lawyer. I'm handballing questions.
No. But I gave a simple example. But where you can add complexities when you have competing risk factors, right? So if you have competing risk factors, is okay, I have 50K to spend and I have a variety of risks that are in front of my face, right? At this moment in time, what's the greater risk? That 1% $10 million fine or my business surviving for the next 6 months, right? Clearly the bigger risk is that your business won't survive in the next 6 months. So that's where you have, a more like logical allocation to allocate into making your business work, right? Than actually allocating legal. And sometimes I think folks overvalue how much legal can save your business and undervalue how much running a good business is good legal. And I'll get into that in a second. Any questions here? So this is my spectrum of risk that I kind of set up. And this is an internal one that I use for my team. So, highly illegal, fraudulent is a pump and dump, right? You got offsides. Offside is profit distributing token, right? That's offside. A technical breach means that it's technically like offside from a legal standpoint, but it's not really going to be enforced that hard, right? So then that's kind of like running your marketing onshore, right? Especially if you're marketing your token onshore. That's a technical breach, but not that hard. Overall defensible is kind of having a kind of split onshore, offshore key kind of structure where it's not the private keys fully being operated from an onshore system. But here, low risk is a visual NFT that actually looks good. Stress the actually looks good. And then my whole joke is always you're operating a cupcake store if there's no risk, right? You're in an industry that is filled with risk, right? You have not only legal risk from regulators and risk from class actions, which are a higher risk, and I'll get into that in a second, but you also have a variety of other risks around social engineering, fundraising, IP breaches, et cetera, right? So it's an industry filled with risk, but that's where the opportunity comes. There is no good opportunity without risk. Like that's the biggest lie that like society has ever told us. They said, get a good job, go work at Amazon, get a good education, and then maybe one day like your boss will go to the moon. In reality, right, like success and upside is based upon the risk that you take and you're able to succeed with that risk. So what are the main risks? A lot of people think that the main risk is kind of regulatory action. I will argue here that your main risk is your incompetence. And like, no, like, and I say that very lovingly. I started my firm when I was, like 27. I didn't know what I was doing. And I had to learn really, really hard how to run a business. And I came in as a lawyer. I came in as someone passionate about crypto. I had a technical skill, but I had no skill in terms of how to run a business, right? And what I realized is, actually the actual skill that is so completely lacking is the skill of running a business. And actually being able to operate, scale a proper business will reduce a lot of risk for you guys. And I feel it because we're both kind of technical in a certain aspect, but just because you're amazing at making coffee doesn't mean that you're going to be an amazing kind of coffee shop owner, right? And just because you're amazing at like any other technical skill doesn't mean that you're going to be able to run a business on that skill. So you guys being able to run businesses there is going to be such a key, value add and risk reduction mechanism for you guys. All right, so let's get into some case studies here because I think case studies are fun. This is a wall of words. You don't have to read it, but our logo's cool. So we had a client back in the day. They were launching, a L1. And this is a brilliant dev, very kind of charismatic, but also very technically talented, and was able to get a lot of interest into his L1 and got a lot of investment. He then was able to issue out, ERC20 receipt tokens that were able to trade in the open market on his L1. The dev started to do this thing where he was able to get traction with a lot of big sports teams and was able to, I may give away who the client is if you look this up, but like if he started to get these mega sponsorships with huge sports teams, right? And the way he did it was he would sign these agreements in which he would put kind of a amount of his token in escrow, and then anytime he had to pay the sponsorship for these sports teams and athletes, like fucking global athletes, he would then sell his tokens and pay them cash. And he almost became totally obsessed with this, right? And every time I would talk to him, he's like, I'm signing a deal with this car company, and I'm signing a deal with this sports team, and I'm signing a deal with all these guys. And, you know, it was very exciting. You know, you get to see your client on a kind of sports team logo and whatnot. But long story short, he became obsessed with it to the detriment of the actual product, right? And then the L1 was delayed for multiple years. FTX happened, market crashed. He couldn't pay the sponsorships. Investors flooded because they were like, hey, you promised the L1 in a year. Now it's been over 2 years. What's going on? And he got a class action lawsuit from his investors. And then he also got a lawsuit from all the sports teams that he signed these multiple $1 million contracts with. And when the L1 launched, it launched to an absolute whisper, and it was totally a nothing burger at the time it launched. So what are some key lessons here do you guys see from this fact pattern? Like what are you guys noticing about what this guy did wrong? Yeah.
He focused a lot on like vanity without actual like the substance. Like I don't see any plan on how to launch an L1 or anything. I think he just wants to be a celebrity pretty bad.
Yeah. Now, why do you think he did that? Like, why do you think he did that? Why do you think he concentrated so much on this marketing to the detriment of any development work? Does anyone have any ideas?
High perceived value.
High perceived value, but think about it from this. Think about it from an opportunity cost perspective, right? When you're running a business, you really need to know where to allocate your time and resources. And when you launch a token, it can actually consume your resources, right? There's a lot of work to be done, and I'll get into that in a second. But it can be, and there's so much work to be done, but then you also get kind of caught up in the hype, right? If your token launches to any kind of good reception, next thing you know, you're looking at your treasury, maybe you're looking at your token allocation, and you're like, fuck, I'm a multiple millionaire, right? And you're like, holy shit, I'm worth like $10 million. And you're getting really pumped that you're worth $10 million. Maybe you got a little strut in your step. Maybe you buy a new Rollie, you're a little feeling good about yourself. You're like, Dad, Mom, I made it. I'm not a fucking loser. And then your token price collapses by 30%. And you're like, oh shit, I just lost $3 million today. And that feels fucking weird. And what do you do? What do you instinctively do when you have lost $3 million?
Depends on your bank account.
Probably. You try to make it back, and you try to make it back as quickly as you can. And you see that the marketing is such an easy, it is a drug. It's an easy drug that gets you back to $10 million. And you're like, oh, I can sign another sponsorship. And now it's up to 12. Another sponsor is up to 15. And you can kind of keep this going, and you get obsessed with it. It's almost like what's that Lord of the Rings kind of character with Gobble? Yeah, exactly. Gollum, sorry, yeah. So, sorry, I'm really bad at Lord. So, long story short, it's having that kind of knowledge in the moment that the reason why your token exists in the first place is because of the product, right? And if it doesn't actually have a product to attach itself to it, and I'll get into mimetic design in a second, but like if it doesn't have a project to attach itself to it, if there's no actual underlying value accrual, and you're just focusing on the token itself, you're really taking such a short-term view of what's actually happening in your ecosystem rather than, that long-term kind of, value accrual mechanisms. What are some other kind of mistakes you guys see from this guy? If any?
It took him 3 years, and there was like a 1-year plan, and he didn't plan properly. He didn't really plan anything. Neither did his team or anyone else, or the investors. They didn't do their due diligence around his team.
Yeah.
It seems to be no work.
Exactly. By the way, your roadmap is your biggest enemy. Your roadmap is your biggest enemy, because I will guarantee you never hit your roadmap, ever. Why? Because I'm sorry, you're incompetent at execution. Like I'm not being shitty. Like it's very hard to execute as a team. Like Simon runs a business. He understands like intimately. Like it's actually really hard to get everyone working together in an organized fashion, hitting metrics, hitting KPIs. It's extremely hard. So by the time you're coming out and you're putting a roadmap it's just like euchre. You're putting a bet into the ether, and you're saying, I will hit this bet. But if you don't hit this bet, you create community FUD, right? And when you create community FUD, communities are very fickle, right? They're very fickle around projects because of the amount of rug pulls that are happening. So the moment that you say, we're gonna have TG at this date, or we're gonna have MVP by this date, and that date comes and goes, right? There's only so much the community is gonna give you slack on until they're gonna start saying, are you rugging this, bro? And then you have a downward spiral from there. So that's a really good point, right? And what I would suggest is just to be reasonable. It's actually better to be like extra conservative. If you do want to have a roadmap, put it out there and just also, disclaim it being like, hey, we're going to aim for this as a target, but we may not hit it because you probably won't. Any other stuff? Yeah.
I would almost say like oversold to the wrong crowd, like sports franchises and sports stars, other than selling NFTs of themselves. Like they're not interested in another L1. Like it just would mean absolutely nothing to them. So it just doesn't make any sense.
Exactly. This kind of just captures the broader coal market. Do you guys know what coals are? Key opinion leaders? Yeah. So when you launch a token, a lot of folks will get these influencers, right? That will pump your token, right? What they'll usually do is some fucking bullshit where they'll take a bunch of your token, they'll argue for like the best lockup ever. They'll then like kind of write like 1 or 2 tweets. They'll take your tokens, they'll dump it in the market, and you're fucked, right? The concept that people are actually going to buy your token because you have paid these guys, because you've paid a sports team or a big star or whatever, is farcical, right? Like that is again back to this drug of going into trying to create hype around the project when really the project doesn't even have the worthiness of hype, right? Before you get all the attention, you really need to make sure you have a product, you have a vision, you have a mission, and that you have something that you can actually show that your token and your project can actually, have value and have strong product market fit, right? Because without those, then you're just another hype asset, and that comes up and comes down as much as possible. So you're absolutely right. Like, be really careful with the type of guys that you bring in to help influence your project, because sometimes they'll take a lot more and win, and you'll get none of the benefit. Any other ones? Yeah.
It sounds like this founder viewed his token as, first of all, just helps money go up, and like a simple feature, but tokens are like an entire parallel product to your main products.
100%.
Well-managed token has its own set of marketing communications needs, it has its own set of legal needs, it has its own set of like operational funding and execution, it has its own set of partners that are required. And it sounds like he totally lost his ability to execute main products by launching his second products in the token.
100%. And this is one of the things that I think founders in crypto really need to understand is exactly what he said, is that you're not only launching one startup, you're launching two startups, right? And it's hard enough to launch one startup. So in terms of you being a good manager and executor of a business, you have to actually be in the top 10% of people who are able to manage and execute businesses to be able to pull this off, right? And I'll get into kind of why that is, but, and I think if I could advise one thing, and this is actual legal advice, is like learn business management, right? Learn what it takes to create a culture, create systems, create processes, create a scaling and growing business, right? And then learn how to do that effectively. Because by learning how to do that effectively, you reduce regulatory risk. That's the biggest risk. Because when regulation comes in and where law comes in? When shit goes badly. No one is upset when things are going well. When things go badly, that's when everything gets stress tested. And when your shit stinks and things go badly, it will come out and it will stink really hard. One last one, just to move it along, is your token is not collateral for $80 million in sponsorships. Okay? Haven't we learned? This was prior to FTX, but, do not, and be very careful in the types of agreements that you're signing with people, because the moment that you start signing agreements that you're putting up your token as collateral, that will then secure an obligation, especially an obligation in the multiples of millions, right? The moment that your token price collapses, your token, that whole basis of the value that's supporting that contract is also going to collapse. And then you're totally up shit's creek. Well, you see this countless times. And a lot of projects still do this, right? Like it's like no one's learned. Like a lot of the tier 2 exchanges, the Gates, the Mexis. Sorry, I think one of them is here. Sorry, I shouldn't crap on them. But like a lot of the times is that they are still using their token, to basically collateralize lend to create liquidity for themselves, right? But don't enter into that type of, experience. A token is really an IOU. When you issue out a token, it's an IOU, and that IOU is that you're going to be able to generate value through a network economy that will then be able to create value for the entire network. All right, so this is just key takeaways. The founder had the right intentions, but made strategic errors. Your token isn't free internet money, it's an IOU. And he definitely would have benefited from strategic insight and support, of course. All right, next kind of situation here. This one's funny. So we had this founder who was just like a super, go-getter, entrepreneur, could probably hit everything that he wanted to hit in life, but came in and was so desperado to launch the token because he really needed money, right? He couldn't raise effectively. He felt that if he just got to the TGE and was able to list his token on a big exchange or a big enough exchange, that he would make enough money to finance it all. Based upon that, he signed a variety of predatory agreements against our advice with people to get him listed on exchanges, for people to market make for him. And long story short, the token launched. It did your classic reverse L hockey stick into nothingness, and he basically made no money. And
How did he make no money?
because what he did is that he signed agreements with the market maker. Because he was so desperado, one of the exchanges wanted him to put up $600,000 to list on their exchange. So, yeah.
Which exchange was that?
Yeah, I won't name names, but a
The
lot.
guy has 600K, he puts it on an exchange, but he's desperado for TGE.
He thought that if he could pay and get onto this exchange, which is a big exchange, it's not Binance, but it's like good tier 2 exchange. If he could get onto this tier 2 exchange, pay $600K, that all his monetary problems would go away. Because he would say we would have enough fucking liquidity from this exchange, and fuck it, I'll tell you, it's KuCoin. But he had enough liquidity on the exchange that it would that would solve that issue. But he needed that $600K because he didn't have it. So what did he do? He borrowed it from his market maker. His market maker then got him to sign an agreement. Again, we didn't want any of this, but he said, sign an agreement where they would eat up 100% of the proceeds from the TGE to recuperate their money, 50% up to 1.5 million, and then down to like 20% after that.
He was your client?
Yeah.
Well, yeah. That's such a bad deal.
I know it is. We were telling him it was a bad deal, but he was incapable of listening. Yeah. So,
Some clients need to be fired.
he fired himself.
Yeah.
He actually lost his job. Yeah. So he lost his job, but anyway, long story short, what happened was as TGE happened, the TGE actually didn't go too badly because they actually had they had a very MVP product, a decent community. There was a lot of hype around his community, which is good, but the product was still not there. TGE happened, market makers took all the money, he barely got anything himself, right? And next thing you know, he's back at square one where he was, but now with a token to support, with no money to support it. Sorry?
Should have just launched a pump.
Yeah.
It really would have been better.
Yeah, it would have been way better. So a lot of these exchanges, by the way, really take an arm and a leg. Depends on the exchange, right? And it depends on how hype your token is and how hype your project is. If your project is not very hype, they will recuperate all of their money on the listing fee right away before you list, right? And that's part of their business model. And I bring this up because a lot of people think that once they TGE, it's all rainbows and butterflies. It is literally not that. It is totally the opposite. It is the most work you will ever have to do. It is way, way harder to support a token and a platform. And you really have to be intelligent about doing it because you don't want to be out here cutting $500,000 checks to obscure Chinese exchanges just for like the dream of being able to like buy and sell on their exchange. You have a question?
No.
No? Okay. Anyway, do you guys see any other problems with this guy, generally speaking?
He seems to not have listened to his lawyers, right?
He didn't listen to his lawyers. He didn't listen to his advisors or anyone. Now, another problem that he did is one of the things that we were advising was for us to push his TGE back, right? Because his product wasn't there, his marketing wasn't there, nothing was organized. So we said, look, you can't launch a token when you barely have a product out there. Like you have an app, but it's barely working. And he's like, I don't have a choice. I got to launch my token now. And this is a problem that I see a lot of people do is that they overemphasize the timing of their TGE and they always try to TGE during good market upticks. But a lot of times good market upticks won't trickle down to your obscure token. So I think it's overvaluing that type of kind of timing of the token. Now there's obviously exceptions. I'm really speaking right now about like classic platform tokens, right? Where you have a token and a platform, they interact together in a variety of ways. But you can have a variety of ways of listings these days. Fair launches have been really popular. Do you guys know what that is? Fair launch, yeah. So fair launches have been really popular, and I think with fair launches you have a little bit more flexibility, way less cost than listing on these big guys, et cetera, et cetera. But yeah, do you guys see any other issues with this guy that from that perspective, yeah.
It doesn't have any investing periods, no lockups, so you're getting all your tokens dumped at once. Then you have all that sell pressure, and you can't counterbalance it because you're not buying it back, because you got no money, because you already robbed Peter to pay Paul for the exchange.
Absolutely.
And even in the instance where everything else can be locked up, it takes a very small amount of the token that is not locked up, that is either liquid with the exchanges, which they use for collateral when you list it, and anything that kind of gets put in liquidity, which gets used for these types of deals last minute. It takes a very small amount of that token to be constantly dumped over a few week period where this can happen, and then you can never recover. So even you could have like 90% of people still locked up, everything nice, and I know this is where you're going next, but it's like, it gotta be even tighter than that.
Yeah.
Yeah.
So, you're absolutely right. And to go into the lockups, I think lockups are one of these things just to level set with everyone. So part of like the crypto financing structure is that like you have a company, you go to investors, you say, hey, investor, invest in my shit. And then you give them some equity and you give them a token warrant, right? And then that token warrant converts into tokens. And then when it converts into tokens at TGE, they have this thing called a lockup where they're forced to hold it for a period of time, right? Now, obviously, investors are thirsty to make alpha and just peace, right? Except the good ones. But you'll have a variety of people asking for tokens and a variety of people putting lots of pressure on you to reduce the lockups. I'll tell you, if an investor is saying, I want a 3-month lockup only, they're not a good investor, right? They're not a partner, right? Don't listen to them. Number one, from a legal standpoint in the US, you need at least a 12-month lockup under Rule 144. So if you ever are in doubt with your guys and be like, look, I want to be compliant with US rules, I want to be locked up under Rule 144 for 1 year. So it needs to be at least 1 year. Yeah.
Does that also apply to SAFs as well? Like,
Yeah.
You're gonna do like a short-term SAF, it still has to be a year.
Yeah, because the reason why it's set up that way is because when you're setting a SAFT, you're actually doing a SAFT under, and this is US rules, you're doing a SAFT under what's called a Reg D exemption, which is a credit investor exemption. The credit investor exemption means that the assets that you sell, which is a security, like a SAFT is a securities instrument, the assets of that convert under that convertible instrument are also going to be locked up for 1 year, right? The reason why they do this is to prevent people from like fake IPOing, where they'll, sell a bunch of instruments that convert into shares, give shares that then people then can, transfer more freely afterwards. So they have a 1 year lockup there to make that happen. And it applies analogously to tokens. So that's why that rule exists. We don't have a similar rule in Canada, but in Canada, you have a full resale restriction under 45102, which is our national instrument that governs like resale restrictions. And that just says that any sale of a token needs to be done under the credit investor basis, especially ones that are received by SAFs. So what we'll do in this instance is that you'll just sell it to some dude outside of Canada, like an OTC desk or something. We'll usually, if we're representing the company that's Canadian based, we'll set up an OTC desk, like through one of our partners, that will be able to always purchase the token for your investors.
You say accredited investors as in?
Really, really rich people.
No, I know that. Usually they don't have the KYC under 200K. Does that still apply to Canada as well, or is that?
So in Canada, so when you do a raise, you can do a raise onshore through your Canadian entity, or you can do a raise offshore through your token offshore structure. On the onshore structure, you technically don't have any obligation to do KYC. We still do KYC with our clients just from a risk-based approach, just to be on the safe side, just to make sure that no one's throwing any kind of stones at you about that. From the offshore setup in the BVI, you have a KYC obligation. It's quite low bar because it's a KYC obligation, not related to virtual asset service businesses or money service businesses, but it's more around kind of token issuances, which is a bit more of a lighter touch. But yeah. So, but there isn't, I don't remember a 200K threshold. It's really based upon the business activities that you're doing. Yeah. Okay. So there we go. So really key takeaways. The founder rushed the token, did not budget, did not plan, and he would have been more beneficial to listen to people, right? And I think sometimes something that's important is, though I'm a lawyer, you've seen many of my talk today has really not been about legal stuff, right? But in reality, it is all legal because it's all about what I care about more is you guys having successful companies that reduce your risk, right? For me, that's legal. But also, I've been able to see multiple token launches and been part of them for the last 8 years. So a lot of times having, someone that you can even like bounce ideas off of, like what have you seen in the ecosystem, I think can be an extremely valuable insight here, because you guys will probably only launch a token once in your life, or maybe a couple of times. But if you've done it multiple times, you definitely get a bit of traction from that. All right, my tokenomics rant. This is fun. So do you guys know what tokenomics are? Everyone knows what that is? Okay, so my biggest gripe with tokenomics and why I think it's like a huge fail and why it creates so much regulatory uncertainty is because there's nothing that we talk about demand side. Like what's demand side variables in tokenomics? Does anybody know?
The utility.
The utility. And how is that measured?
Find out the number of active users, okay, what they can potentially do with the token, how it powers the app. For an L1, it's pretty straightforward, but for other dApps and protocols, it can vary.
Cool. Yeah, exactly. So how do you measure that?
So let's say if you have 2,000 daily active users and they could use your token in a certain way, then you sort of estimate, let's say, what's the demand for the token once it launches. And that's just like one variable.
And how many people do you think do this?
1%.
Most people are more concentrated on the south side.
Correct. But I'll make an argument here that who gives a fuck about supply side variables, right? Like if you look at it from an economics lens, right? Is crypto from a supply side highly elastic or highly inelastic? What that means in economics is, does demand side shocks or supply side shocks change the price of the good extremely highly or extremely like in a low
Extremely
fashion?
elastic.
It's extremely elastic.
Yeah.
Exactly. Right. An example of a highly inelastic good is if you have, if you have an oil embargo, right, and there's an oil restriction to the U.S. and that skyrockets oil prices, demand will not decrease of oil that much, right? At least not in the short to medium term, because it's highly inelastic. Whereas in crypto, you basically have interest rates setting, huge variability in the market. So much so, it's so elastic that sometimes you think Ethereum was made out of zinc, right? Like the fact that it reacted more to zinc tariffs in Canada than zinc commodities itself, which is kind of ridiculous, right? So a lot of times you're going to be sold by these guys who are going to do tokenomics. These guys are the bullshitters, and they really are going to need to take in what I call demand side variables into account. So what I created here is, who did economics as a kid in undergrad? Anyone? Oh, sick. We got some people here. So is this giving you PTSD?
Yep.
All right, good. So here is kind of a supply and a demand function, right? So the supply function basically shifts out based upon all categories, a sum of all categories of unlocks, right? So if you list all the people that have a lockup schedule, you can map out what the unlock schedule is, and you can map out how the supply curve is actually moving to the right. The demand is similar to what you said. Where it's users, average users after, over a monthly average spend, right? So you see your average users, the average growth of the users. You see how much users are spending, and you can map out demand, right? So why I bring this up is because you're all quite smart. You can actually simulate this, right? You can build a simulation to simulate demand. And you can build a simulation to know how much you need demand to be to always outstrip supply. You can know where the demand curve needs to be initially to outstrip supply. And you also can know how often the demand curve needs to shift right to always consistently outstrip supply. Because you can actually have this in your tokenomics model. You can have a model where your demand is always outstripping supply. And what does that mean? That means that your token will always have price appreciation. Now, it can't go on forever, obviously, unless you have exponential growth, but this is something that you can track, right? And you can adjust dynamically over time. Any questions on this? No, does everyone understand that concept? Good, because why I bring it up is because there are two main variables that you can control here. Actually, a couple of main variables that you can control here to make sure that you have a successful token launch. One is to make sure you find product market fit prior to launching your token, right? And I think this is really underestimated. Most crypto products suck, and a lot of times they're just hype pieces for your token. I'm looking at Ustar Atlas, and really just trying to build a good product that has a good market prior than actually before launching the token is extremely important. And you could start with creating in-game or synthetic tokens before launching your TGE. Having long lockups is key. And then this is the most important one, is that you can actually track data and adjust your supply restrictions, right? To ensure that when you launch, you're always going to have this situation because you're in control of your TGE. You get to choose when it happens, right? So if you can choose when your TGE happens, you can choose when the lockup starts to count down, right? And that's a huge power. And that means you should actually really push your TGE out, right? Because if you can push it out to ensure that you actually have a product market fit that works, then you can feel confident that this date will always match your demand side, your demand side variables. So hire professionals. I think we work with a couple of guys that we really like on the economic modeling, which they actually do demand side modeling. And I think that's really important. If you guys don't feel comfortable doing it yourself, it's not rocket science. Like I did a undergrad in econ and I did this myself. Like, it's like, you could probably run it through ChatGPT seriously, but even if you're not feeling comfortable with it, you can get someone, to do this for you. And they can obviously give you some more insights than this, and then obviously launch your platform when the demand variables are favorable. So you may say, well, you may enter into these positions where you need money and things are difficult, right? And this is where I see a lot of times with a lot of projects, they get a bit desperado, right? But this kind of comes back to the effectiveness of running a successful business. You with a token, you have a great power, right? Imagine your friends who are running kind of like med tech companies or other boring stuff that, the government VCs like. They can raise money, but they have a really big downside is that those investors are locked up for 10 years before they see liquidity. The fact that you have a token and can give an investor liquidity in 3 years, give them a higher alpha, also give them a safe as well, which is a type of note that's used a lot in startup land. You have an advantage here to make sure that you can raise money effectively to be able to build a business. And one nice thing about crypto companies is that you can actually build a profitable business almost right from the get-go, right? If you're building anything to do in the financial trading market, DeFi markets, or like a DEX aggregator, or some sort of like synthetic index fund platform, there's a lot of ways that you can make money almost immediately, right? That's harder for some of your Web 2 startups, which technically have quite a bit of ways to go before they're profitable, and that means that they have to raise a lot more before they get there. So you have to think about the tools in your toolkit that will make you succeed. The fact that you can run a successful business from the get-go. Hey, good to see you, man. Yeah, what's up? they could run a successful business from the get-go, or you have a token that will be able to entice investors a lot quicker than the classic VC investors. Trust me right now that the VC investors do really love a token, right? And they really love a token because that's where they can make most of their money. But it's also playing with fire, right? As I've showed you, a lot of times having these VCs as this unlocked hidden supply dumping on your community, right, is also extremely dangerous. So it's an opportunity, but it's also a word of warning here that being able to like plan this out very meticulously and not rushing through it and making sure that you are operationally sophisticated, you and your team, or you guys are managing yourselves well, you're managing your team well, you have a strong culture in place, you're building systems and processes in which you are executing, you have a high output culture with accountability. That's what's going to actually make you into a success. And at the end of the day, that's actually what's going to reduce most of your legal, worries, because in the long run, good, well-run businesses have less legal problems. All right, I'm going to quickly do how we do kind of this token structuring. You may have seen this before, but a lot of times what we'll do is we'll set you up with a Canadian Labs Co. The Canadian Labs Co. will create the, basically the IP. The token will be issued through a Cayman BVI structure, right? In which we then issue out the token from this structure, and this foundation then actually becomes kind of the non-for-profit that runs your token. And then sometimes we'll create, a Panama operating code to operate stuff in the DeFi space. And the reason being is because Panama is kind of the new Wild West. So that's why sometimes we get to use it, but these jurisdictions are much more credible, and it's nice to work in jurisdictions that have like English common law, because there's a lot of like business similarities here, business culture similarities. I don't know if you guys have worked in other places before, but sometimes working in places with very different business culture is very hard to do. Try working in Brazil or Turkey. I'm making fun of you. So any questions on this?
Where is Delaware?
It's in the United States.
Yeah. But like, isn't that like supposedly the best place if you're raising, the best place if you're talking with VCs?
Yeah, so there's a movement. So there's a movement, and this ebbs and flows over time, but there's a movement from the US-based VCs to make you incorporate labs in Delaware, right? And it's a movement that comes and goes. It kind of faded away during COVID, but now it's back with a vengeance, right? And it's a movement that I'll gladly incorporate you, a Delaware VC. It does the same stuff here, but I think it comes with a couple of key disadvantages that people don't really talk about. Number one, there's a tax disadvantage because you're still in Canada, right? Number two, there's a shred disadvantage, given the fact that you get, Canada has the most non-dilutive funding from government agencies in the world, right? And if you're going to move yourself to the United States, then you have also other factors where you have talent that's expensive and a USD that is then, from a price point standpoint against CAD, there's no kind of, FX benefits there. And I think for us, if you guys, and I kind of spoke about this with Simon at our panel yesterday, but if you guys really want to build and ensure that we have a strong startup ecosystem in Canada, I think we can collectively start really making the pitch about why investing in Canadian talent is so important. Number one, you guys are obviously extremely talented, and we've seen so many talented folks come in in this building right now. But also we can talk about the fact that it's cheaper to hire the talent here, right? You got just a lower cost of living than in Boston and SF. Maybe not in downtown Toronto, but I'm speaking about anywhere else in Canada, from Newfoundland to Manitoba to Montreal even. And you have a USD CAD exchange rate, which is hugely beneficial. If they invest in USD and you are spending in CAD, that goes a long way. And also we have to remember the non-dilutive funding aspect. For every dollar that a US investor invests in a Canadian company, you're going to be able to get 35 cents at least back through non-dilutive shred funding and other types of grant programs that the Canadian government gives. So the fact that you can make that pitch to them, you can say you can buy Canadian talent and businesses that are comparable to your US counterparts at value, right? Like at a good price. And I think that's a pitch that you guys can make to VCs when they do tell you to move to Delaware. Because I think they don't know. Because every time I make that pitch to them, they're like, huh?
I didn't know.
Yeah, exactly. They'll be like, oh, what? Like 35 cents on the dollar? I'm like, yeah, bro. They're like, fuck Delaware, fuck that shit. And then they'll tell you to just stay there, right? So I think there's a couple of good ways that you can pitch and use Canada as an advantage here, right? And I think having labs here in Canada, unless you want to move, but having labs here in Canada from a regulatory standpoint, you know, the way that we set it up ensures that, like, you know, back to the regulatory risk spectrum is overall defensible, so that you can at least be able to, like, you know, build labs, you know, build strong product and have value accrue here to you and your business here, you know, without being, you know, totally risk on with respect to regulatory risk. Any other questions? All right. I'm almost done here, but last slide really is kind of just to make sure that you know kind of the people and partners that you're going to need to work with. You know, treasury managers, offshore directors, market makers, exchange launch pads, Coles, community marketers, developers, security auditors, and legal. These are kind of the groups of people that are going to be working with you during this time. And if you ever need anybody in this space or want, you know, any connections to the space, we're always happy to, like, add value through our network for folks in the Solana community. Okay. Any questions? Oh yeah, and some good offers here. So with the hackathon, top teams get $300K of pro bono legal work with us. That was very graciously offered by the super team. So they're and I guess us too. And
You're offering.
yeah. So, and then we also added another 10% off for the Solana ecosystem on their first month if they decide to kind of work with us. No pressure. You know, I'm just kind of here to support, and if I can be of a supportive role, make sure that you guys are building here and building good projects here, I'm always happy to support. Cool. Any questions? Yeah.
I'm advising many projects, but most of them are small ones. Based on this workshop, what I realized, please correct me if I'm wrong. If the numbers are not reaching millions, it doesn't make sense to bring this topic up.
To bring legal up?
Yeah. Because I will tell them, just say, don't promise anything, don't put out a roadmap, say this is only vibe and nothing else. Doing the safe side until you get there.
So I think there's many increments of this, right? And I think there's really easy stuff that you can do right now that go a long way, right? Like, for instance, an easy thing that you can do, super easy, is you incorporate a company and you launch your token from that company. That's really fucking easy.
What if you don't?
Then you're fucked.
How?
If your token makes millions, you have effectively sold a good.
It's a very nice headache to have because usually they don't see that.
Good. Well, it's a very big headache when 53% of your of the price of your token that you have been sold goes to the government. So if you want that headache, that's fine. Like, you can pay it to them. But the thing is when you sell it, when you issue a token and the private key is in your name, that is a sale of a good from you, as no different than a dude making those little wooden spoons, like, on the street. Like, it's the same thing, right? You know which guy I'm talking about? Yeah. So, like, it's like he sold 1 million of those for $1 and made $1 million. So there's a marginal tax rate, so he'll be on the top of the tax rate, and a big part of it will be eaten up by 53.3%, right? So 53.3% of every dollar he made above a certain threshold will go to the government. If you put it in a corporation, you get a flat tax of 26.5. So you can save, just by spending $1,000 on a corp, you can save, like, you could plan for things going well, right? That's what I'm saying. And you can put the token in a corp, and, you know, like, using that example, you would save probably $200,000 to $250,000.
Incorporating is $500.
It's just like these little things that you can do that can be like, that can go a long way if things go well. If nothing goes well, then, it depends on what doesn't go well. Sometimes no one knows about you, so no harm, no foul. Maybe you rugged someone. That's also something terrible. Like if then you have a corporation that shields you, right, from any damages. Because if you get sued personally, I can access all your assets. You may not have much, but I can access all of it, right? If a corporation does the work and it gets sued, it can only access their assets. So that means if the corporation doesn't have any assets, then the person who's suing is shit out of luck. So that's another benefit of a corporation, is that you have a limitation of liability. Sorry, you're looking distraught here.
Because they don't do it like this. It's not like that. People just, at least many do this. They put out a token. As soon as, if it's do good, they will bring up the company, they make it a shell, they buy the token, they just started, so they go with a clean sheet for legal. Before that, it's too much of a headache. You just have to go on them. If your token gets traction, you have to go for the legal stuff.
Yeah,
CRA would say they have a personal tax.
they would have a personal tax. So if you buy the token, if you have a 40% of token supply and your token's trading at X amount, you technically have to buy it at fair market value because it's a non-arm's length transaction, right? So as a non-arm's length transaction, what that means in tax law is, let's say I'm about to sue you for a lot of money and you sell your house to your mom for $1, right? And then you're like, shit, man, I don't have any assets. I sold my house to my mom for $1. Sorry. The law will say, no. That actually is worth this amount. And you owe taxes to the fair market value of the transfer that you made to your mom, right? So in a similar vein, you can't incorporate a company, sell a token that's worth $1 for nothing to that company that's also owned by you and be like, hey, dude, So that doesn't work. Like anything that you think is sneaky, I'm just going to say that if you think you're doing something sneaky, it's been figured out. So don't the sneaky stuff, you really have to be sneaky to be sneaky. Yeah.
Could they do like a Section 85?
You could do a Section 85 rollover.
Like
Yeah.
That's not going to save you, but it sort of defers.
No, but it does. Yeah, so you could do a Section 85 rollover, right? Because a crypto is an eligible asset. So you can actually roll it in, which is a really good way of doing it. No, a rollover is great, right? But you have to do the rollover.
Yeah.
So the rollover is basically a way for people to defer taxes when they're corporate restructuring, right? I'll give you an example. Let's say you were a dentist and you had a dentistry practice, but you were running it as a sole proprietorship from your name. And then you wanted to grow it and wanted to hire some people. So you incorporated a company. You wanted to sell the assets of the practice that's in your personal name to that company. Instead of paying fair market value, the government gives you this tax deferred transaction that you can do and then sell it to there, and you can sell it at a reasonable price. Yeah. So thanks for bringing that up. Any other questions? All right. Oh, we got one more. Yeah, sorry.
Yeah, so if you incorporate and like everything goes to shit, you're not personally liable in any way, shape, or form. Like it can't come to you in any way.
Except in cases of fraud, willful misconduct, recklessness, etc. But the principle, if you guys want to hear a fun fact, so back in the day, you used to have these conquistadors that would go to North America to basically like loot, get slaves, all that jazz. Yeah, extract value. Yeah. But what happened was a lot of those ventures were very risky, right? So they would not come back with any gold or slaves or anything of the sort. And then these guys would lose all their money. So people like Christopher Columbus or like Cortez were in and out of debt. They were like millionaires at a certain point, and then they lost everything at another point, blah, blah, blah. So they created this concept of a corporation to limit liability of the promoter of the venture so that they don't have to lose everything if their venture didn't go well, right? I bring that up because that's the history of it, but down to the nitty gritty, if you are fraudulent, if you are reckless, if you're like, doing careless misrepresentation, all those things can have personal liability. There are exceptions where you can breach the corporate veil, that's what it's called, and they can sue you directly. So long story short, as long as you're acting in the best interest of the business and not doing anything that's illegal, then the lawsuit will be contained in the corporation.
And you can get director's insurance as well to get additional protection on top of that.
But the problem is people likely won't lend you money unless you give them a personal guarantee, so. that kind of-
That's a Canadian banking thing because they're a bunch of prissy chicks. Who booed them? Yeah. Any other cues?
Let's end on a high note, since you really quickly mentioned shreds, and we have a whole bunch of scary risk topics and like money spending topics. You use Buddy as an example and tell them, how shreds are really cool for tech companies in Canada.
For sure. And I think that's something that I would really think that everyone should do. I think one thing that you can do is you can go on to Fundica X Desjardins, just type that into Google, and they have a platform that scrapes all the government grants that your company will be eligible for. You ask a very simple question. I hope it's still up. You ask a very simple question, and then it basically will show you all the grants that you can be eligible for. The main one that everyone's eligible for is SHRED. I think, Dave, you want to speak maybe a bit about SHRED and how we kind of go through it?
Happy to quickly. And it's actually a tax credit, not like a straight up grant. And it is after you've spent the money on developers doing novel things within Canada. If they're a contractor, you can get around 35% of the money back. So if you had a $100,000 contractor, you go ahead and you apply to government, you get $35,000 of that back. If they're a full-blown employee of your company and then you're paying all the additional benefits, all the overhead, EI, taxes, you can get upwards of around 70% of that money back. So yet again, same employee, $100,000, and they're doing novel tech development. After you spent that $100,000, you can get up to $70,000 of that money back. So now you have another, you have 70% of that employee back, you have to roll it again. So as the example that Topeka was giving when you asked about Delaware, is the reason to keep that in Canada is because your dollar can go so much further if you structure this properly. And especially nowadays, I would say with AI, you can have a much leaner, tighter team. And if you keep everybody here and you really level everybody up, that money can go much, much further. And the problem we're talking about mostly here is people were launching bloody tokens before they had real tech, before they had a business. You can stay much leaner, much smaller, much longer, and make your money go further. So that when you do release everything, your upside goes up massively. And that's just one. If you guys have other very niche things you're looking for, happy to chat more. There's just kind of infinite ways to make your dollar go far, especially in Canada. And it's one of the advantages we do have over the US, I would say right now, is all these options.
What's the website that we use? The one that
Fundica might be down right now, so
Yeah.
or it's gone private as a higher end business. But even the government of Canada has a good website. You just go in and fill out a form and be like, I am a Quebec business that is 3 years old. I am a minority, you know what I mean? I'm from wherever. I'm building an AI company, and they'll just spit out a list for you. So that's a good one. I use Ripen is really good, and Level Up is great. ICTC we've used a bunch. I'm missing any. Just IRAP is great. That's a bit higher end, but IRAP is great. There's really a lot of ways to keep going far, and yet again, just proving that you're doing something novel. Not be like, oh, I just forked ETH and I'm doing an ERC20 token. You can't pitch that for these things. You have to show that you're doing novel experimentation, development, and increasing the overall IP of Canada, so that the Canadian government has more assets, let's say, in the country, and they're going to fund you for that, and they're going to want to keep that going. My tax is another one for my private universities. Question?
Can this be, does this have to be applied to before you set up the company? After you set up the company, let's say you already paid a bunch of employees and contractors. Oh, I just heard about Shred. I want to get into it.
If you started the company, and this is the way it works for everybody, we've done it for a lot of projects we have, as long as you started the company and you were paying all those people out of the company, you have about 18 months after you first started paying them to be able to get that money back. So you don't need to pay them on May 1 and then start trying to get it back June 1 next month. You actually have if you started now, you started the company today, start paying people, you would have until let's say fall of 2026, and you can retroactively go back and get that money, but it needed to have been paid from an incorporated company out of your bank account or even out of your crypto account. I've gotten it back from crypto and I've paid people because I showed that I had an invoice for it and I paid them out, and get that money back in CAD direct deposit right in your RBC account kind of thing. So as long as you're not just paying out of your pocket, as long as you actually incorporate it and, yeah, get going.
Awesome.
Cool. All right, guys. Well, thanks for coming down. This is where we can connect. You can connect with me on Telegram or email. And happy to chat and help you guys out. And thanks for the super team guys for giving us this opportunity. It's been amazing. So we'll have office hours here for the next hour or so. So if you guys have any questions, we have them here or we can have them.
Would you like to have them be like one-on-one, smaller room with people?
Those, that's,
I don't-
Telegram.
Yeah, I'm not sure.
We really want to
We can do one-on-ones, yeah. Let's do one-on-one.